$80.54. That's the number that should be keeping every silver trader awake right now. Because as of this morning, March 15th, 2026, silver touched $80.54 per ounce. That is the intraday low printed today, on a day when the metal cratered another 4.4% in a single session. And if you think that number is just another dip in a volatile market, I need you to pay very close attention to what I'm about to walk you through. Because that $80.54 figure isn't just a price. It represents the bottom edge of a range that, if it breaks convincingly, sets in motion a sequence of events that the silver market has only seen twice in the last 100 years. And both times, the people who understood what was happening positioned themselves correctly. The people who didn't, they watched years of gains evaporate in days. By the time you finish watching this video, you will understand exactly why today's move happened, what the next 48 hours mean, why the 30-day high of roughly $121.62 on January 29th wasn't just a top, it was a warning, and what the data is telling us right now about where this market is actually headed. Not what the headlines are saying, the actual data, because those two things are very different stories right now, and that gap between them is where the real opportunity, or the real danger, lives. Let me give you the full picture of what we're dealing with here. Silver entered 2025 trading at roughly $30 an ounce. By January 29th of this year, it had hit $121.62. That is a 305% gain in 15 months. Then on January 31st, 2026, it experienced its single worst day since March 1980. It dropped 31.4% in one session, settling at $78.53 per ounce. Within days of that, it recovered back toward the mid-80s. And now, today, as I'm recording this, it slid again to a fresh session low of $80.54. So what we have is a 30-day range that goes from $121.62 at the high all the way down to $80.54 today. That's a $41.08 spread. If you were positioned long from anywhere near that $121 peak, you have watched your silver position lose roughly 34% of its value in 6 weeks. Now here's the question I need you to sit with. Does that mean silver is broken? Or does it mean something entirely different is happening? Something that, if you understand the historical pattern, actually looks a lot more familiar than it's being presented. I want to be completely transparent about where this data is coming from, because I'm not asking you to trust my opinion. I'm walking you through documented, verifiable information. The price data I'm referencing comes from live market feeds tracked by outlets including Fortune, Kitco, and Trading Economics, cross-referenced against COMEX settlement data and the Silver Institute's published supply-demand reports. The COMEX delivery figures I'm about to show you are pulled from CME Group's own filings. The China supply restriction details come from Beijing's official licensing framework, published November 2025 and effective January 1, 2026. JP Morgan's positioning commentary is from their published global research note. You can verify every single number I'm about to give you. And here's what the data shows when you put it all together. This isn't a random chaotic sell-off. This is a pattern. Specifically, it's a pattern that has played out in 3 major precious metals markets over the last 50 years. And understanding those 3 instances is the key to understanding what happens next. Before I get into the historical pattern, quick message for those watching who haven't subscribed yet. My analytics show roughly 3 out of every 4 people watching right now are not subscribed. If this kind of deep dive analysis, where I actually pull the primary source data and walk you through it rather than just telling you what to think, is cutting through the noise for you, hit subscribe. That's how I know who the committed community is. It helps me keep doing this work, and frankly, it helps the algorithm show this to other people who are trying to navigate what is genuinely one of the most complex precious metals environments in a generation. Now, the 3 historical instances. First, 1979 to 1980, the Hunt brothers silver play. Silver ran from roughly $6 an ounce in early 1979 to nearly $50 by January of 1980, a 733% gain. Then the CME, same exchange we're dealing with today, raised margin requirements repeatedly and aggressively. The metal crashed back to $11 within 2 months. If you'd bought near the top without understanding what was driving it, you gave back everything. If you'd understood that the margin intervention was clearing out over-leveraged positions rather than killing the fundamental demand story, you knew the long-term structure was still intact. Silver eventually went on to have decades-long cycles of new highs. Second instance, 2010 to 2011. Silver ran from $18 in August 2010 to nearly $50 in April 2011, a 177% gain in 8 months. Again, the CME raised margins. 5 times in 9 days in fact. The metal dropped almost 30% in weeks. Same pattern. Forced deleveraging of leveraged positions, not a structural collapse of the metal itself. Prices eventually recovered and continued to move based on the underlying demand cycle. Third instance, and this is the one that looks most like today, 2020, COVID panic. Silver crashed from $18 all the way down to $11.77 in March 2020, a 35% drop. Looked like a disaster. Within 5 months it had recovered to $29, a 146% rebound from that low. The fundamental demand story hadn't changed. The crash was caused by forced liquidation in a liquidity crisis, not by a change in the underlying supply-demand structure. Here is the critical point. In all 3 of those cases, the pattern was the same. A dramatic price run, followed by a forced deleveraging event, triggered either by margin hikes or macro shocks, followed by a period of consolidation, followed by a resumption of the underlying structural trend. And in all 3 cases, the people who panicked at the bottom, they sold right before the recovery. The people who understood the pattern held and reassessed. So which stage are we in right now? Based on everything the data is telling us, we are in stage 3 of that pattern. The dramatic run happened. The deleveraging event happened. We are now in consolidation. And the question the next 48 hours will go a long way toward answering is whether that consolidation holds, or whether we get one more flush lower before the structural story reasserts itself. Let me pile on the evidence now, because this is where it gets genuinely alarming. Not from a panic standpoint, but from a you need to understand what's really going on standpoint. Start with the supply side. According to data published by the Silver Institute, the global silver market ran a deficit of approximately 230 million ounces in 2025. Total demand came in at an estimated 1.24 billion ounces. Total supply, including mine production, recycling, everything, came in at roughly 1.01 billion ounces. That is a 230 million ounce hole. To put that in perspective, that shortfall is roughly equal to the entire annual silver output of Mexico, which is the world's largest silver-producing nation. And this wasn't a one-year anomaly. According to the Silver Institute and HSBC's 2026 Silver Outlook, this was the 6th consecutive year of supply deficit. 6 years in a row, the world has consumed more silver than it has produced. Now here's what makes that structural deficit particularly difficult to solve. The vast majority of silver mining, we're talking roughly 70 to 80% of output, is produced as a byproduct of copper, zinc, and lead mining. That means even if silver prices double or triple, miners cannot simply decide to dig up more silver. Their production decisions are driven by base metal economics. And developing a new dedicated silver mine from discovery to production takes somewhere between 8 and 12 years. So you cannot solve a supply deficit in silver quickly. It's not like soybeans where farmers can plant more acres next season. This is years-long structural tightness. Now add China into that equation. On January 1st, 2026, Beijing implemented a new silver export licensing framework. Under that framework, only firms with annual production capacity of at least 80 tons of silver and credit lines of approximately $30 million are permitted to export. That requirement eliminates hundreds of small and mid-sized Chinese exporters who have historically served global industrial buyers and refineries. Now, China controls somewhere between 60 and 70% of the world's refined silver supply. When you restrict 60 to 70% of global refined supply, even partially, the reverberations are immediate. This move mirrors almost exactly what Beijing did with rare earth metals years earlier, where export controls were introduced gradually and then progressively tightened as a geopolitical tool. The impact on downstream industries is acute. According to analysis from FX Street and supply chain data from the Silver Institute, the International Energy Agency estimates that by 2030, the solar and EV sectors alone will consume half of global silver output. Each solar panel uses approximately 20 grams of silver. Each electric vehicle uses roughly 2 ounces. Electronics and semiconductor manufacturing, AI data centers, advanced chip packages, all depend on silver paste for conductivity, and there is no viable substitute at scale. Industrial demand accounted for approximately 59% of total silver usage in 2025. That demand is effectively inelastic. When the factory needs silver to run the production line, it buys the silver regardless of price. Stick with me because this next part is critical. Now layer in what happened at COMEX, the largest silver futures exchange in the world. According to CME Group's own filings and analysis published by Discovery Alert and multiple financial research outlets, registered silver, That's the silver that is formally available for delivery against COMEX contracts, dropped from approximately 167 million ounces in October 2025 down to roughly 103 million ounces by early 2026. That is a 38% plunge in a matter of months. At certain points, the drain rate was running at approximately 785,000 ounces per day. Think about that for a second. That's like watching someone drain a bathtub while the faucet is only barely running. But here's where it gets truly alarming. In January 2026, COMEX silver deliveries hit 49.4 million ounces, a normally quiet month in the delivery cycle. In just the first few days of February, nearly 19 million ounces were delivered, almost matching the entire February 2025 total in the first week alone. And almost 100% of open interest was standing for delivery. In a normal functioning futures market, somewhere between 5 and 20% of contracts result in actual physical delivery. The rest are rolled or settled in cash. When nearly 100% of contracts demand actual metal, that is not a normal futures market. That is a market where participants have stopped trusting paper promises and are demanding the real thing. According to a TechFlow analysis published in February 2026, open interest in the March contracts represented between 425 and 455 million ounces of theoretical delivery obligation, against registered silver of roughly 103 million ounces. Even if only 20% of those contracts demanded physical delivery, a conservative estimate, the math simply does not work. The metal is not there to honor those obligations. And yet, despite all of that, despite 6 consecutive years of supply deficits, despite China restricting 60 to 70% of global refined supply, despite COMEX inventories plunging 38% in months, despite nearly unprecedented physical delivery demand, the price today is $80.54. I need you to really think about that for a moment, because there is a fundamental disconnect here between what the paper market is saying and what the physical market is showing. And one of those two things is telling the truth about value, and the other one is telling you a story. A University of Zurich study published on March 11, 2026 by Professor Thorsten Hens and Alvin Amstein found that precious metals, particularly gold and silver, are essential components of long-term wealth accumulation, not merely speculative plays. Their data since 1972 showed that a portfolio of 85% equities combined with 15% precious metals delivered higher long-term returns than a pure equity allocation, even after accounting for taxes and inflation. That's the institutional academic consensus now, not fringe theory. So why is the price at $80.54 if everything I just described screams structural scarcity? This is where we have to talk about the mechanics of what actually happened in January and what's driving the current pressure. On January 31st, 2026, the single biggest driver of the crash was a news event. President Trump announced the nomination of Kevin Warsh as the next Federal Reserve Chair. Warsh is known as one of the most hawkish voices in monetary policy, the man who opposed quantitative easing during the 2008 financial crisis. The moment that nomination hit the wires, the entire thesis underpinning the metals rally, the so-called dollar debasement trade, got repriced in real time. Traders who had built massive leveraged positions betting on loose monetary policy, low rates, and a weakening dollar suddenly found themselves on the wrong side of a narrative shift. And they didn't walk for the exits, they ran. According to analysis published by finance magnates and citing research from Polish analyst Maksymilian Bączkowski of Comparec.pl, major investment banks, with JP Morgan reportedly prominent among them, had built massive short positions as silver climbed toward $121. At that price level, unrealized losses on those short positions exceeded $10 billion, with JP Morgan alone accounting for over $5 billion of that exposure. The crash on January 31st resolved that situation. And here is the detail that Bączkowski flagged as remarkable. JP Morgan reportedly closed approximately $10 billion in silver shorts at or near the exact market bottom, with 633 delivery notices settled at the precise low price. That level of precision in timing a trade of that size does not happen by accident in a normal market. Now let me show you the structural side of the margin equation, because it's the same playbook we've seen before. CME Group issued Advisory 25-393 on December 26, 2025. That advisory raised the maintenance margin for March 2026 silver contracts from $22,000 per contract to $25,000 per contract, a 13.6% increase. The market largely ignored it, and prices continued climbing toward the $84 range. On December 30th, CME struck again with a 30% increase, bringing total initial margin requirements to $32,500 per 5,000-ounce contract. In the span of 1 week, the capital required to hold a standard silver position increased by nearly 50%. To understand why this matters, think about how leveraged futures trading works. If you're holding a contract worth roughly $400,000 in notional silver value, and your margin requirement goes from $22,000 to $32,500 in 1 week, you either come up with the additional capital immediately or you liquidate. For tens of thousands of retail and smaller institutional traders, there is no come up with the capital option. You sell. And when everyone is forced to sell simultaneously, regardless of what they believe the fundamental value is, prices cascade downward. This is precisely what happened in 2011. CME raised margins 5 times in 9 days, and silver crashed nearly 30% in weeks. The script for January 2026 was written in 2011, word for word. By late 2025, according to a financial content analysis, the paper-to-physical silver ratio, the amount of paper silver traded compared to physical ounces sitting in registered vaults, stood at approximately 356 to 1. 356 ounces of paper for every 1 ounce of real metal. That ratio is the pressure gauge, and in January it blew. Here's the disconnect I want you to really sit with, and I want to describe it with some precision. When silver hit its intraday low of $74 to $75 on January 31st, what were dealers doing in the physical market? According to first-hand accounts documented by Gold Silver Vault's February 2026 analysis, the physical chain largely locked up. Refiners pulled out. Wholesalers delayed payments. Coin shops were bidding $10 to $15 below spot price for silver rounds, meaning they were paying significantly less than what the exchange said silver was worth because they had no confidence in the paper price or in their ability to source metal efficiently. And yet, simultaneously, demand for physical silver bars, 1 kilogram bars specifically, had jumped over 500% since late 2025. The screen said one price. The physical market was doing something completely different. That divergence, the paper price collapsing while physical demand remains structurally elevated, is the signature of what analysts call a physicalization event. Shanghai silver premiums relative to COMEX prices had reached $5 to $8 above the New York exchange price as early as January 1, 2026, according to data cited in a financial content analysis of CME's margin actions. Some estimates put Shanghai and Dubai physical premiums even higher at their peak. The physical market in the East was paying more for real metal than the paper market in the West was pricing it. That is not how a functioning, unified market is supposed to work. When you see that divergence, one of two things is true. Either the paper price is too high and needs to come down, or the paper price is being artificially depressed and needs to come up. Given the supply data we just walked through, I'll let you decide which you think is more likely. Now let me bring the current situation into sharp focus. Today, March 15, 2026, silver is trading between $80.54 and $81.34 per ounce. That's your intraday range as of this morning. The driving force today is a strengthening US dollar, fueled by fading expectations for near-term Federal Reserve rate cuts, combined with the Middle East conflict premium beginning to ease as the immediate peak of fear passes. From a technical standpoint, according to TradingView analysis of COMEX silver futures, the key support levels you need to be watching are $78.50, that's the prior week's breakout level, and below that, $72.50, which represents the post-flash crash recovery base. Resistance sits at $84.71, the February 22nd intraday high, and above that at $92.25, which is the prior all-time high retest zone from January. The gold-silver ratio right now sits at approximately 60 to 62 to 1, meaning it takes roughly 61 ounces of silver to buy 1 ounce of gold. Historically, that ratio has averaged between 50 and 70 to 1, so we're within the normal range. But what's notable is that this ratio was at 105 to 1 as recently as early 2025, meaning silver was historically cheap relative to gold. The compression from 105 to 61 in 1 year tells you that silver has done significant repricing. The question is whether that repricing is finished, or whether we're in a pause before the next leg. JP Morgan's published research notes, citing analyst Greg Shearer from their global research team, states clearly, they maintain a buy-the-dip thesis on gold, but on silver they are, quote, much more apprehensive, and don't necessarily trust that you have shaken the full amount of froth out of this price. They warn explicitly that on a bad day for gold of 1 to 2%, silver can drop 10 to 15%. That asymmetric volatility is the defining characteristic of silver trading right now, and if you're positioned in silver and haven't sized your position for that kind of daily swing, that's the first adjustment I'd want to understand. This is not financial advice. I want to be very clear about that. I'm not a licensed financial advisor, I'm not your broker, and nothing in this video should be taken as a recommendation to buy or sell any security or commodity. What I'm doing is walking you through the data so you can make your own informed decisions. With that absolutely clear, let me lay out what I see as the 5 most important things to understand about what this data means for different people in different situations. First, if you are a leveraged futures trader in silver, the next 48 hours are genuinely critical. The $78.50 support level is the line. According to technical analysis from multiple sources including TradingView's COMEX futures board, a decisive break below $78.50 opens the door to $72.50. That would represent another 10% drop from today's low. Leveraged positions have been getting shaken out since January. If the dollar continues to strengthen on Fed rhetoric this week, the pressure on paper silver continues. Position sizing and stop-loss discipline right now are not optional, they're survival. Second, if you hold physical silver, the calculus is fundamentally different. Physical silver does not get margin called. It does not get force liquidated. The supply deficit, 6 consecutive years, 230 million ounces short in 2025 alone, does not go away because the paper price drops. China's export licensing restrictions are not reversing. Industrial demand from solar, EVs, AI infrastructure, and semiconductors is not declining. The fundamentals that drove silver from $30 to $121 have not changed. What changed was the speculative overlay on top of those fundamentals getting aggressively cleared out. For physical holders, this correction looks very different than for futures traders. Third, if you are considering entering silver for the first time, the range you need to understand is this. JP Morgan's cautious scenario has a downside floor around $50 to $60 in their bear case. Their average expectation for 2026 is $81 per ounce. Goldman Sachs and Citigroup remain constructive longer term. HSBC sees a $58 to $88 trading range for the year. That tells you the professional consensus broadly sees current prices as being within or near fair value for 2026, but with meaningful downside risk if macro conditions deteriorate further, and meaningful upside if supply stress reasserts. Fourth, the physical and paper markets diverging is something to watch extremely closely over the next several weeks. If COMEX registered inventories continue declining, remember they dropped from 167 million ounces to 103 million ounces in just a few months, and if physical delivery demand remains elevated, the pressure underneath the paper price builds. Watch the COMEX delivery reports. Watch the registered versus eligible inventory figures. Those are the real-time gauges of whether the physical stress is resolving or escalating. Fifth, and this is the one I think is most underappreciated, watch what happens with China's export licensing enforcement through March and April. Only 44 companies are currently authorized to export silver under the new framework, according to data published in early 2026 supply chain analyses. How strictly that framework is applied, and whether it gets tightened further, is arguably the single biggest supply-side variable in the global silver market for the rest of the year. Let me bring this full circle now because I want to make sure the key points are crystallized. We started with $80.54. That's today's intraday low, down 4.4% on the session, driven by a stronger dollar and fading Fed rate cut expectations amid Middle East tensions. Over the last 30 days, silver has ranged from that $80.54 low all the way up to the all-time high of $121.62 on January 29th. That is a $41 swing, roughly 34% of peak value. The cause of the January 31st crash was a convergence of events. The Warsh Fed nomination shocking the dollar debasement trade, CME margin hikes forcing mass leveraged liquidations, from $22,000 to $32,500 per contract in a single week, and Chinese traders operating with futures margins as low as 2.5%, getting wiped out as algorithms targeted stop-loss levels simultaneously. According to the gold-silver vault analysis of the crash, the magnitude was not fundamentally driven. It was structurally driven. Reckless leverage meeting a narrative shock in a thin market. Underneath all of that, 6 consecutive years of supply deficit, a 230 million ounce shortfall in 2025 alone. COMEX registered inventory down 38% in months. China restricting 60 to 70% of global refined supply through the new export licensing framework. Industrial demand from solar, EVs, and AI consuming 59% of total silver usage and growing relentlessly. a paper-to-physical ratio that reached 356 to 1, and a delivery market where nearly 100% of open interest demanded physical metal rather than rolling, a number that is supposed to be 5 to 20%. The people who didn't see the 1980 silver crash coming thought the Hunt brothers rally would go on forever. They were wrong, and they gave everything back. The people who misread the 2011 correction thought the run to $50 was over and sold at the bottom. They watched silver go on to stage multiple recoveries and consolidations over the following years. In every one of those cycles, the people who got hurt were the ones who either didn't understand the leverage dynamics or didn't understand the fundamental story well enough to hold through volatility. The signs right now are not hidden. The data is documented, publicly available, and consistent. 6 years of deficits, COMEX inventory collapse, China weaponizing its refining dominance, industrial demand structurally inelastic, margin mechanics clearing out speculative froth. The 48-hour window we're in right now, as the dollar strengthens and silver tests the low end of its recent range, is a critical juncture. Does the $78.50 to $80 zone hold as support, or does the next leg of deleveraging begin? You now have everything you need to understand what's happening. What you do with that understanding is your decision, made with proper advice from qualified professionals who know your specific financial situation. Before I close, I want to hear from you. Drop a comment and tell me this. Do you think the $80.54 level holds as a floor? Or are you watching for a test of the $72.50 support before silver finds its footing for the next structural move? I read every single comment on this channel. Your perspective genuinely shapes what I research and cover next, and some of the best angles I've ever explored came directly from the community here. If this level of analysis is useful to you, the kind that actually goes into the CME margin filings and the COMEX delivery data and the Chinese licensing framework, rather than just telling you, silver is down, here's why. Subscribe if you haven't already. Share this video with anyone you know who's watching the silver market right now, because the next 48 hours matter. And understanding why they matter is the difference between reacting and positioning. This is the silver story that the 30-second headline cannot tell. Now you know it. Stay disciplined. See you in the next one.